Okay, can you hear me? Can everybody hear me? Perfect, all good now. Sorry about that. We're back in the game. Okay, so just to start again, this is all about the FBI trading setup, which is one of my proprietary trading strategies, which I use to help determine whether there's been a false breakout or a market trap. So as I say, many of the big moves in the markets tend to occur after a false breakout of some kind, and these are called market traps. So traps are formed when traders are caught on the wrong side of the market. Now, very often they'll form after a technical move, for example, the break of a support level or the break of a resistance level, but often they have a fundamental trigger, i.e. a news-related move. So I've developed a trading methodology, which I call break and retrace, to help capitalize on these market traps. So this is essentially what break and retrace looks like, and this is the buy example, the long example. So the market starts off at a equilibrium point, if you will, the origin of the move, and then we get a sharp break to the downside. Now this can either be news related or it can be just a break of a support level. So either way, we get a sharp break to the downside. Now what usually happens after a sharp break to the downside is the market will correct a little bit, go sideways to higher, and then further selling will come in and it will take the market lower. But what I'm looking for are the kind of the more rare situations where the market actually retraces all of the breakout move. So we find ourselves back towards that origin point. So once we get back to that origin point, we know that anybody who's sold the market on or after a piece of news or the break of a support level, they're all losing money. And it will be their buying that helps push the market up going forward. So the FBI pattern, what's that all about? The FBI pattern employs break and retrace methodology. And FBI simply stands for false break of inside bar. That's all it is, false break of inside bar. So what we're doing here is we're trying to identify an inside bar, which is simply a bar on which the high is lower than the previous bar's high, and a low which is higher than the previous bar's low. So basically the whole of the current range is inside the previous bar's range. Okay, so inside bars basically reflect indecision, and we have a contraction in volatility. So when the market does this, usually that's a precursor to a big move one way or the other. So what we're looking for is for the market to, number one, form an inside bar, and then number two, break out. And when the market breaks out of an inside bar, as I say, usually you will see some follow through buying or selling. People buy the breakout or sell the breakout of the inside bar. So you can imagine there are stops above the inside bar's high and stops below the inside bar's low to sell the market. So as I say, what I'm looking for is the breakout to occur. That's the break from break and retrace. But if that breakout fails to see follow through buying, then the people who bought the breakout start to get a bit nervous and they start to offload their long positions in a bullish breakout. And then we start to see a reversal unfold. So the trap is confirmed if we return to the other side of the inside bar. So break and retrace, watch this space. So this is what the inside bar looks like for those who are not that familiar with technical terminology. So basically, as I say, the high of the bar, once the bar has been completed, is below the high of the previous bar. Also, the low of the bar, once completed, is above the low of the previous bar. So all of today's, if it's a daily chart, all of today's range has formed with inside the previous bar's range. Okay, so that's essentially what the pattern looks like, the inside bar pattern. So now let's talk in more detail about how the trap forms. First of all, I'm going to talk about the bull trap, which is the sell setup or the sell signal. So the pattern is often seen, it forms at important market tops. So the way it forms is the market trending higher, it sees a push in the direction of the existing uptrend. So in other words, we get an inside bar and then the market breaks through the top of the inside bar, the high, resuming the trend, and everybody is expecting the trend to continue. So The push through is followed by a brief pause as profit taking ensues. And then we get a correction which sees this contracting volatility, and we get the inside range. After the correction, we get this new high. But if that move is not sustained, then we get that reversal start to unfold. Because remember, people who buy the breakout of the inside bar are expecting higher prices to follow. And if that doesn't materialize, then they start to get a bit nervous. Then they start to exit their losing long positions. And before you know it, push comes to shove and we get a bearish reversal. And that's what we're looking for here. So a bull trap is confirmed on the loss of the inside bar's low. So this is what it looks like. This is the setup. So we have an inside bar formed, sometimes during an uptrend, sometimes maybe just during a sideways piece of price action. So what we get is the market breaking through the top of the inside bars pattern, this one here. The market pushes through, that's the break. Remember, break and retrace. So we get the market breaking through the top of the inside bars high. Okay, now if the move doesn't see follow through buying as one would normally expect it would, normally when we break through the top of the inside bars high, we should see the market up here. But if we don't see that and the market starts to reverse, then the nervous buyers will start to exit their losing long positions. And before you know it, we find ourselves back down at the other side of the range, the inside range. And once we break through this green line, could be any kind of line, but the bottom of the inside bars pattern, that is when the trap has been sprung. The trap has been, it's complete. So now we are in a position to sell the market, looking for a push lower. Because what we're looking for is all of the people who bought the break of the inside bars high, they are trapped above it. They're trapped above this price. So as the market comes down towards the bottom of their range that they use for reference, once we get to that point, then we're in a kind of tipping point where the market is very likely to start to decline because they're bailing out. They're bailing out of losing long positions. Okay, let's see a few examples of the FBI sell setup. Okay, first up is a currency chart. Let's see what we've got here. We've got literally the market is trading sideways. These are daily bars. The market's moving up and down, up and down. The pink bars on the chart, they represent inside bar patterns. So what we've got here is the market breaking through the top of the inside bar on this day. So people are buying the break of this pink inside bar. But by the end of the day, the market closes back inside the range. In the lower part of today's range, certainly below yesterday's close, and cuts deeply, deeply into the inside bar. So there's the first indication that perhaps this could be a false breakout. Next bar, push comes to shove. We break through the bottom of the inside bars pattern, and then the market crashes. Boom, boom, 2 big days down. Okay, so a good trading opportunity from the short side based on this false break of inside bar, FBI. Okay, that's the first example. Next example, this looks like probably a chart of S&P or maybe even gold. Essentially, the market had been trending higher. We get a bit of a pullback. Then we get an inside bar, and then the buyers come in and they try to resume this trend, which was in place before. So people buy the break of the inside bar, and it actually closes above the top of the inside bar. So at the end of this day, the buyers of the breakout are very happy. They've bought the breakout, the market's closed significantly above their entry point, and they're looking quite good. But then something happens kind of on the way to heaven. The next day, the market opens, gaps open down, and then we break through the bottom of the inside bar pattern. And that completes the trap. These people here who bought the breakout, happy as they were on the close, not so happy when the market is breaking down here. And that turns out to be the start of a new multi-day downtrend. And that's essentially what you're using these patterns for. You're using them to give you a bit of an early warning that a trend may be about to reverse, or even a new trend may be about to start. On the same chart, we've got another example. This one happened on the same bar. So essentially what we had was an inside bar followed by an outside bar. So we had the break of yesterday's high, and then by the end of the session, the market broke all the way back through it and then closed significantly down. So we have a bullish push to the upside, a reversal, break and retrace, down it goes. And then for the next few sessions, it crashes. it goes down, because all of these buyers are bailing out of losing long positions. It's all about market positioning. Okay, another example here. This one, the market starts off by actually breaking out of an inside bar here at this point. This turned out to be quite a good breakout. The market didn't do a trap. The market did what it was supposed to do. It broke through the top of the inside bar and it continued higher for the next few days. But then we got to the top of this little uptrend here, and the market broke through this inside bar's high, and by the end of the session found itself through the bottom of the pattern and closing, well, just a little bit above it, but certainly way down on the day. And that turned out to be a major top for this market. Not a bad place to think about having a go at the short side, selling this market, because we've seen the FBI sell setup. Okay, one more example here. The market looks like one of the yen markets. So the market starts off basing out and then forming a bullish uptrend, series of higher highs and higher lows. Everybody is bullish and happy. And then we get this inside bar right here, just before the top. So then we get the late buyers who maybe missed out on all this fun. They come in, they buy the break of the inside bar, because that normally means the market wants to go higher. But by the end of the session, the market closes significantly back inside the inside bar's range. Next bar, we get the break to the downside, or the break and the retrace. We break through the other side of the inside bar pattern. So break through the high, trapping the buyers, break through the low, that's the top. Then the market falls for the next few sessions. So a good trading opportunity for the swing trader looking to grab some profits over maybe 3 or 4 trading sessions. Okay, so as I always say, what works on the upside should also work on the downside when it comes to trading and technical analysis. So now we're going to talk about the FBI bear trap, which is the buy signal, the bullish example. So this one is often seen at important market bottoms. So starts off, the market sees a push in the direction of the existing downtrend. The push is followed by a brief pause as profit taking kicks in. And then we see this the correction, which sees contracting volatility, where the range forms an inside range. So the high is lower than the previous bar's high, and the high is lower than the previous bar's high, and the low is greater than the previous bar's low. So we see this contraction in range, contraction in volatility. So there's a kind of a state of equilibrium going on. Once that correction has been completed, the market then pushes down, breaks through the bottom of the inside bar low, makes a new low for the downtrend, but the move isn't sustained, and a bullish upside reversal takes hold. That confirms the bear trap once we get back above the high of the inside bar pattern. And this is what it looks like. So the market is trending down, the bears are in control, everybody's bearish. Then we get this little correction, sideways correction, which sees an inside bar, lower high, higher low, so contraction, okay? Then we get this break to the downside. So this looks like an easy sell for the bears. Maybe some of the bears who missed out on some of this good action here, they sell the breakout, looking for the market to continue down. Now, very often it does. That's what the textbooks will tell you, that when you break through the bottom of an inside bar pattern, it should continue down, because demand is less than supply at that price. But what I'm looking for, obviously, is the market to first of all break down, and then retrace all the way back up through the top of this inside bar pattern. And that's the buy setup. That's when the trap has been sprung. Okay, so let's take a look at a few examples of the FBI buy setup. Oops, there we go. Okay, so first off, we've got this market, looks a bit like euro dollar. Starts off, we are trending down, making lower highs and lower lows. And there we have in pink this inside bar, okay? Now we get the bearish resolution to the inside bar, which is quite normal in a bear market because we're in a bearish phase. So we get the break of this inside bar and the market collapses. That's normal. That's normal price action. And that's why people sell the break of these inside bars or protect themselves with sell stops if they happen to be long. In this case, yes, the market broke through the bottom of the inside bar pattern, Saw big move to the downside, lots of opportunity there for the intraday trader for sure. And then the market closed quite weak. Then we get another inside bar pattern here. So the inside bar pattern basically represents a little bit of profit taking before the trend sees another extreme. So yeah, the market rallied, but met resistance here and then closed quite weak, forming the inside bars pattern. Then on the next day, the market broke through the bottom of the inside bar pattern, triggering sell stops. And then it broke through the swing low, triggering some more sell stops. So we've got people selling the break of the inside bar pattern here. We've got people selling the break of the swing low, the trend low, which is normal because when that happens, normally you expect the market to continue down. But by the end of the session, the market found itself much higher. So any of these break sellers on this day, anyone who sold the break here, by the end of the session, they're not feeling too clever. And then obviously, once we break through the top of the inside bar pattern on the next day, that's the trigger. That's the trigger for the buy. So basically, as we're breaking through this green line here, which is the high for the inside bar pattern, we get this big explosion in buying as the stops are being triggered. So what we're talking about is short sellers, these people who are trapped, they're getting out of their long positions, but also we're getting buyers come in, actual buyers, because they're buying the breakout of the inside bar pattern, because the inside bar pattern usually leads to stronger prices if the market breaks to the upside. So what happened afterwards? Yep, the market saw a big move on the breakout day here, closed a little bit off the highs. Next day, an attempt to go down, and yet another big up day. So what we got here is the start of a multi-day, if not multi-week uptrend, just by recognizing, identifying this inside bar pattern and having a strategy that works around trading based on the inside bar false breakout. Just as an aside, I like to point this one out when I'm talking about market price action. The market likes to do these series of maybe 2 consecutive days on which we see big movements. So very often you'll see this situation where the market breaks out, boom, boom, and then it turns down, and it goes down 1, 2, then it turns 1, 2, then another turn. And it's quite a common facet. So basically, if you're long the market and you see 2 of these big up days, then it can be a good time to think, well, maybe it's time to take some profits off the table. Or even if you're really aggressive, have a crack at the short side of the market. But that's something completely different, and that's for another time. Okay, back to the examples. What we've got here, this looks like an Aussie or a Kiwi. The market breaks down quite sharply and then forms a bit of a base. And then we get this inside bar pattern right here. So next bar, we get very, very marginal break of the low of the inside bar pattern right there. So there are people selling the break of that low, looking for this market to extend its downtrend. But something happens again on the way to heaven, and by the end of the session, the market finds itself back up near the top of this inside bar range. So how are you feeling if you sold the break of this low by the end of the session, if you're still holding that position? Without doubt, I'd say most people would be having their stop losses above the high of the inside bar pattern, because if you're selling the break of a low, you're usually putting a stop above the high. That's essentially typical trading strategy stuff. So next day, the market starts to creep higher, and then it breaks through the top of this inside bar pattern, the high of the inside bar pattern. So we've got the break to the downside, break to the upside, break and retrace, and then boom, up it goes. And this is the start of an amazing 3-4 day run for this market. So again, identifying the inside bar pattern, having the patience to wait for the false break of the inside bar pattern and not be sucked into the straight breakout, it can be a good strategy. And they don't come around that often. That's the thing about the inside bar patterns. They're not that common, and certainly the false break of the inside bar pattern are obviously even less common. So when they come around, they are quite good opportunities to have a crack at the market. Okay, yet another example. This time what we've got is we've got an example of a buy and an example of a sell on the same chart. So what we've got here, we start off with the market quite strong. We get an inside bar, correcting the strong day, big up day. Then we got this small, well, quite big actually in terms of range, but small net change inside day. And then the buyers push it through. But again, by the end of the session, the market retraces. So we get the break and we get the retrace. By the end of the session, the market is not looking too strong. It's settling at the lower end of the inside bar range. So the people who bought the breakout, if they're still holding by the end of the day, they are underwater. And again, that comes back to the whole positioning idea about this particular setup, and many of the setups that I teach, I talk about on a regular basis. It's all about market positioning. So we get the market pushing higher, dragging sucking in some of the buyers who are looking for higher prices. But by the end of the session, the market's much lower. So they're disappointed. You've got to think about the psychological backdrop to what's going on the charts. So the market breaks to the upside, retraces down. Once we break through the low for the inside bar pattern, which is this green line here, that springs the trap. And then we go boom, down, two good days down. So this is an opportunity for, if not the intraday trader, then certainly the multi-day trader who's looking for the market to head on down for maybe 2 or 3 days. Okay, so that's the sell example. And then the market bases out. We get another inside bar pattern here, this pink bar here. And then the sellers come in yet again. They break through the low of the inside bar pattern. Then they break through the low of the swing low. So everybody in the world at this point is bearish. Everybody and his wife at this point are bearish this market because we're breaking through the inside bar low. We're breaking through the swing low. Everything here says sell, no buy signals whatsoever. Until we get to the end of the bar when we find ourselves close much, much higher than where the breakout occurred. So yet again, we've got the people that come in late into the trend who sold the breakout that are on the wrong side of the market. And that provides the fuel for the next bull market to follow. Next bar, we get the break of the inside bars high, and that springs the trap. The trap is slammed shut on all of those sellers down here. And that basically creates the conditions for this massive rally which followed. At the end of the chart, a few inside bars there, but no inside bar false break of inside bar trap set up just yet. Another example, again with buy and a sell on the same chart. This one looks like Dow Jones. So what we've got is essentially the market up here. We get an inside bar formed. The market pushes through the high of the inside bar up here. So people are buying it, looking for an extension of this little trend higher. But by the end of the bar, the market slams lower through the bottom of the inside bar pattern, stopping these guys out. And then the market goes down for a couple of days. So certainly an opportunity there for, if not the day trader, then maybe the beyond the day trader. Wasn't a whole lot of follow through on the downside, but certainly enough to make a little bit of money, I would say. Okay, so then after this move, the market bounces, pulls back, and we're kind of essentially stuck in a bit of a range. Then this inside bar forms here. Okay, the inside bar forms here. Then the sellers come in, they have a go. They have a go at the inside bar. They break through it, albeit very marginally, break through it, they sell the breakout, but by the end of the session, the market finds itself back up, all the way back up through the top of this inside bar pattern. So that springs the trap on the day, on the same day, just as it did on this day. So this day was a sell, this day was a buy. This one proved to be much more potent, much more powerful in terms of follow through. So boom, big close up, then up, and then top out. So good opportunity there for the multi-day swing trader for sure. Again, examples of buys and sells on the same chart. I like to do lots of examples just to kind of hammer the point home. This one started off in a downtrend. So we're kind of making lower highs and lower lows, and the bears are in control of the market. Then we get our friend the inside bar right here. They sell the break of it. More selling comes in on the break of the swing low right here. So everybody's happy as Larry to sell the break of these 2 points here. And then, of course, the market does go down. It does this kind of bungee jump. Something happens during this day. By the end of the session, what a powerful move this is. The sellers of these breakouts are not, I'm sure at the time they can't believe it, the fact the market suddenly finds itself back up here. And the trap is formed when we get back through the top of the inside bar pattern. So again, this is one of those inside out patterns, as I like to call them, inside bar followed by outside bar. So we get inside, outside, break and retrace, up, up. So a bit of a opportunity from the long side of the market, make a little bit of money from the long side of the market, pulls back, bases out, and then we get this bullish trend. Then we form another inside bar right there. So big up day, inside bar. Buyers come in, they buy the break of the inside bar, pushes higher, but then on this day we get again another outside bar. We find ourselves breaking through the low of the inside bar pattern, springing the trap. So just as this was a buy situation, this is a sell situation. Down it goes. Good opportunity to attack the market from the short side, with the information in mind that there are people that are trapped above this high. That's the point. There are people trapped above the inside bar high. And then one more example on the same chart. This one seems to like inside bars. After this big down day, everybody's really bearish at this point. We get the inside bar, and then they come to sell it. They sell it, break of the inside bar's low, close is weak, but not aggressively so. And then the next day, the market starts to pull back. And then we find ourselves back through the top of the inside bar pattern here. This is the place where you buy the market. Break to the downside, retrace to the upside, trap has formed, boom, boom. Great place to buy the market right there. Okay, so that's essentially how the setup looks. I hope it's pretty clear to everybody. But by the way, I'll open it up for some questions at the end if anything's not entirely clear. Okay, so before we look at trading strategies based on FBI, a few words I want to say on market orders I use to enter and exit the market. So they break down into 3 types of orders. So stop orders and limit orders, I'm sure you're all very familiar with, but I'll just quickly go through them. And also time exits, because I find time exits are, people don't talk a whole lot about time exits. They talk about maybe where should I put my stop and maybe where should I take my profits, that kind of thing. But there is a big time element to trading that not everybody understands. Okay, so just to quickly run through stop orders. A sell stop order is an order to sell below the current market price. What you're doing there is you are selling into weakness. So you're selling low, looking to exit short lower. That's what breakout traders would be doing. Sell low, cover short, lower. So sell stops are used for entering short positions and exiting long positions. Okay, so you're entering a position on weakness as the market's breaking down, or if you happen to be long, you want to protect yourself with a sell stop below the market. And I can't emphasize enough every time I talk about trading to people how important having stop losses are, because you never know. At the end of the day, it doesn't matter how good these patterns are and how good a trader might be. You have to protect yourself with a stop loss, because not every single trade you take is going to be right. Not every trade is going to be a winning trade. So you have to limit the losses on your losing trades. Okay, conversely, a buy stop is an order to buy above the current market price. Now, why would you want to buy above the current market price? Well, essentially what you're doing is you are buying into strength. You're buying high, looking to exit your long position even higher. So essentially, that's what you're doing. It's like a momentum type thing. You're using momentum. It's a bit like an auction. The market is being bid up and you're taking part in the auction. You're paying higher and higher prices with a view to the asset that you're buying becoming even more expensive. So stop orders are used for entering long positions and exiting short positions. Okay, and a sell stop order is to enter short positions. Sorry, that's wrong. Enter short positions and exiting long positions. Okay, limit orders. Now, limit order is the opposite, the reverse, I guess, of the stop order. So what you're doing is you are selling at perhaps a more advantageous price or buying at a more advantageous price. So a sell limit order is an order to sell above the current price. So what you're doing is you're selling into strength. You're saying, well, I want to sell the market, but I don't want to sell the market where it is now. I want to sell the market even higher. I'm waiting for the market to come to my price. Buy limit order is the opposite, obviously, where we are looking to buy below the current market price. You're buying into weakness. Why and when would I use limit orders? I use limit orders to take profits. That's simply it. I don't use limit orders to get me into the market, because if you're trying to get into the market based on a limit order, there is no guarantee you'll get the price. And now we talk about time exits. So I use time exits to get me out of a trade after a certain time period has elapsed. So as an example, I'm in a trade and I say, well, okay, I'm in this trade and it's good for maybe 2 days or 3 days. So I put in a time exit that says, no matter if I'm in profit or if I'm in loss, just get me out of the trade after 3 days or 2 days or 5 hours or whatever that number may be. And the reason I do this is because the trades or the trading strategies that I use, that I've created, are momentum based. So momentum is very fickle. It's like a pendulum. It'll swing, it'll reverse, and you never know when it's gonna swing and it's gonna reverse course. So obviously, when you're doing momentum trading, you want to get out hopefully before momentum swings in the opposite direction. So what you're doing really is you're entering a trade. You've got profit targets to exit your profitable winning positions, but you've got a time exit that says, look, this trade is only good for so long, because if I'm doing it, then maybe everybody else is doing it as well after maybe a couple of days. So you don't want to be in the same trade as the rest of the market, because don't forget, the rest of the market very often can be a little bit late to the party. So you want to be in the party nice and early and get out before the police come round, basically. So I'm using the time exit to reduce my risk on the open positions. So I've got an example which I call time, basically. That's essentially gets me out after a certain period of time. Okay, so now let's talk a little bit about trading strategies that one could adopt around the FBI pattern. So how would I trade the FBI buy setup? So first things first, wait for the market to form an inside bar. You can't have an FBI without an inside bar. Second, wait for the break below the inside bar's low, usually within 3 bars. Once we've got that, then we place a stop to buy 3 units above the inside bar's high. So essentially you're getting the break to the downside and you're looking to go long if it breaks through the other side. A bit like a song from the Doors, break on through to the other side. That's essentially what you're looking for. So you break through the bottom and you're looking for a break through the top to get you into the trade, to tell you that the trap has formed. Okay, so let's say this happened, you go long, and then you need to protect your position because it could turn out a bad one. Not everyone is going to be good. So if you're long, place a protective sell stop below the low of the inside bar. That's what I do. Place a sell stop below the low of the inside bar if you happen to be long based on the inside bar pattern. Okay, next thing is to calculate your partial profit targets. So I said place a buy stop for 3 units. I always like to enter in a size which I can divide by 3 so that I can take partial profits at different price levels. I call them PT1 and PT2. So I calculate these levels at which to put limit orders to sell some of my long position. If the market hits them, happy days, take profits, move on. And I use the time stop to exit the balance of my long position. Okay, so this is essentially the graphical representation of the buy trade. So what we get is the market breaking through the bottom of the inside pattern and then retracing all the way through the top of it. That's where we buy our 3 units. Buy our 3 units, put a stop under the low of the inside bar, and that's our protection. This is our risk. If the market falls from this point to this point, we cut it out, we take a small loss, move on, next trade. If things go well, the market starts to move higher. Happy days. We've got our targets at PT1 and PT2. Sometimes I use PT3, sometimes I just use the time exit, because invariably you can catch the home run trade by not having a third profit objective. The time exit does the job for you. Okay, so how to manage the trade? So we buy 3 here, we put a stop here, hit our first target, we sell one of those 3 units. We can then move the stop from our risk level here, below the bottom of the inside pattern, to our entry point. Okay, so we're now long 2 units. If it comes back from PT1 to break even, we exit the other 2 units and we're out for flat on those 2. We've made money just on 1. But if the market continues in our direction, we get a bit lucky. We hit PT2, we sell another one of those units. So now we've got 1 unit left. We move the stop up from entry point to PT1, and now we're just holding the rest of that position until that time exit kicks in. And once that bell rings for time, we get out of the market regardless of where it is. Okay, so how do we trade the FBI sell setup? So wait for the market to form an inside bar, always the first step. Wait for the market to break above the inside bar's high, usually within 3 bars, and then you place a sell stop for 3 units just below the low of the inside bar. If we get triggered, we place a protective buy stop above the high of the inside bar and hold the position for PT1, PT2, and get out on the time-based exit. And here's the picture for the sell. So we start off with the market breaking higher, retracing lower through the bottom of the inside bar pattern. This is where we sell our 3 units. Put a stop loss above the high of the inside bar right there. If the market goes up, stops us out, we get out, no question. It's wrong. Move on to the next trade, but we're risking a small amount. If the market goes in our favor and continues down, we buy back one of those units at PT1, lower the stop from the risk level to the entry point, looking for PT2. Market breaks down, hits PT2, we buy another one of those units, and we have the stop now at PT1. So if the market then bounces from PT2 to PT1, we just get out of the other unit that we're still holding, and we make a bit of profit on that. We've made this distance here. But if we get lucky and the market kind of dribbles sideways or goes even lower into the time exit, cover the rest of the position. Thanks very much. Very good trade. Move on. Next trade. Okay, so just to summarize about the FBI pattern trading setup. So FBI patterns often form during strong trends, both up and down. I've shown you quite a few examples where the market is in a really strong trend. Let's call it an uptrend for now. The market's in a strong uptrend, and then you get this inside bar, and people are still bullish. It's just a very, very minor sideways correction. And then we get the bullish break of this inside bar pattern, and that triggers new buyers to come into the market. And that can often be, as we've seen, the precursor for a reversal in trend. So yeah, FBI patterns often form during strong trends, both up and down. And they often provide early warning that a new trend has started. So what I've shown you is basically what you're doing with this FBI pattern is you're kind of looking around the next corner. You're kind of you're expecting the unexpected. I think that was Sherlock Holmes or Inspector Clouseau, one of those two. You're waiting for the market to do something that not everybody is expecting. What everybody's expecting when the market is in a strong uptrend, forms an inside bar, is for that uptrend to resume on the breakout of the inside bar. The break of the inside bar is the trigger for people to initiate new long positions. But what you're expecting with this setup is for the market, for these buyers to become trapped, to get it wrong, and then for the market to go the other way. And the initial impetus for your profits on the short side of the market is the bailing out of the long positions. Okay, so FBIs can form very good early warning signal that a trend has likely reversed, at least for a couple of bars, whether it be hourly bars or daily bars or weekly or even monthly bars. Essentially, that's what you're doing. You're using the time frame. If you're looking at daily bars and you've got an FBI pattern in play, then maybe you're looking to hold a position for a couple of days, 2 or 3 days, before momentum turns again. So FBI patterns, trading setups provide clear reference points for trading and calculating risk. So you know where the parameters are if you're going to use FBI to trade. You know where the top and the bottom of the inside bar pattern is. You know where those levels are. You can draw them on the charts. You don't even have to be computerized and automated to do these trades. You can just literally print the charts off, draw your lines, identify the inside bar pattern, draw your lines, and you can figure out, okay, if this happens, if we get a break to the downside, then I'm going to put my buy stop on the upside. If it happens within a couple of bars, if it doesn't, cancel the order, move on. Okay, inside bars, or rather the FBI pattern, is valid on all timeframes and markets. Anything that moves, so anything from currency to Bitcoin to stocks, anything that's got a good following, that is driven by technical analysis, that is responding to market psychology, buyers and sellers, greed and fear, anything that is based on that you can chart. This is where the FBI pattern can come into play, and it can be quite a good little tool to have in your trading armory. I always say don't trade with one indicator or one tool alone. Have many. I also strongly recommend to print out loads of charts if you're studying the markets, identify the inside bars, and see whether what I've just told you over the course of this last 45 or so minutes makes any sense. Is this something you could use? You know, is it something that you could employ within your own trading regime? Okay, I think before I close and go for questions, I just want to talk a little bit about money management. I always like to end my trading strategy sessions with a few words on money management, because it's very important. It doesn't matter how good the indicator or the pattern or the method that you employ. If you get the money management side of this trading wrong, then you can get into trouble. It doesn't matter how good, how strong your indicator is. An FBI may be a good indicator. It may not be a good indicator. You know, if you're looking at it from the first instance. But if it's a good indicator, you still need really good risk management. So my advice is always to keep the trade risk constant as a percentage of your open equity. So your trading account will have a cash balance, it will have open equity. So when you're trading, keep your risk constant. In other words, don't change the sizes too much from trade to trade. Keep it roughly equivalent. The worst thing you can do is to come in and say, well, I've got this signal. Usually I risk 1%, but today I feel particularly good. I'm going to risk 5%, you know, because I really fancy this trade and somebody told me this market's going up. So I'm going to risk a bit more on this one. Never a good idea. Try to keep your risk as constant as you possibly can. Size of the risk as a percentage of one's account, everybody is different. A lot of people say 2% is a good rule of thumb, but it just depends on who you are, how you trade, what your objectives are. Some accounts I trade, I'm risking no more than 0.25% on any one trade, and some people even consider that to be a big number. Whereas some other accounts, I'm risking up to 5%. It just depends on the trading mandate that you are using. So everyone will know their own risk threshold levels. So don't stray too far beyond those. Even the best traders suffer drawdown periods. What is drawdown? A series of losing trades, not necessarily consecutive, but a series of losing trades. So when you're trading, whatever you're trading, whether it's FBI, whether it's indicators, whether it's moving averages or patterns or whatever it is, Elliott waves, whatever it is you're doing, you need to allow for a series of losing trades as part of your trading plan. One of the webinars, I don't know if you all saw it, that I do, is on forming a trading plan. So in your trading plan, you should have numbers like, okay, what is the worst case scenario am I prepared to accept in terms of dollars or euro or percentage on my account before on the way to making my trading profits? Last thing to say, be patient and wait for the traps to form. Don't anticipate this pattern in particular. The market's breaking through the top of an inside pattern. Don't sell it. Don't sell it, because invariably the market wants to be breaking higher. When the market breaks through the top of an inside bar pattern, usually technical theory says that if you're breaking through a resistance level, demand is greater than supply at that point. So don't get in the way of that. But what we're doing here, what I'm doing here, is I'm waiting for the market to tell me that the break is fake, the break is false, the trap has formed. That's when you jump in. That's when you take action. Okay, so thank you all very much for attending, for listening. Sorry for the initial hitch at the start. We got there in the end. I'm going to open it up now for a few questions, if there are any questions on the on the content. There we go. Okay, hi there. What's your question, sir or madam? No questions? Okay. How do I watch your previous webinar? If you get in touch with your CFI representative, they will have a record of previous webinars. So yeah, but by all means, please contact your CFI representative, and they'll show you the way. Any other questions out there? Yep, YouTube page of CFI. That's where you can access them. Perfect. Great. Okay. If there are no questions, no more questions. As always, if you think of anything between now and next week, please contact your CFI representative, or you can hunt me down. I post on LinkedIn on a regular basis, so if you wanted to ask me something, I'm always happy to jump in. So perfect. Thanks again for attending, everybody, and same time next week. Thank you.